Hey everyone, and welcome back to the channel where we demystify the markets. Today, we're diving deep into a specific stock that's caught our attention on the hard-to-borrow screener, INLF Limited, ticker INLF. We're going to break down why it's considered hard to borrow, what that massive cost to borrow fee truly means, and what to watch for if you're trying to understand potential short squeeze dynamics. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's talk about INLF. INLF Limited operates in the industrial sector, specifically within specialty industrial machinery. Show logo/company info through subsidiaries. INLF focuses on the research, development, manufacture, and sale of injection molding machine dedicated manipulator arms under the INLF brand, primarily in the People's Republic of China. This is a micro-cap company, meaning it has a relatively small market capitalization, which often translates to higher volatility and unique market dynamics. Looking at recent price action, INLF has seen some significant swings. Today alone, it's up a remarkable plus 21.78%. Over the last 5 days, that gain extends to plus 63.1%. However, zooming out a bit, the stock is down minus 94.5% over the last 30 days, highlighting extreme volatility. Today's volume stands at 1,624,569 shares, which is actually below its 30-day average volume of 4,269,915 shares, giving it a relative volume of 0.4x. Show price chart. What is cost to borrow and why it matters? So, what does it mean for a stock to be hard to borrow? And what is this cost to borrow we often talk about? When you want to short a stock, you essentially borrow shares, sell them, and hope to buy them back later at a lower price to profit from the difference. But borrowing shares isn't free. Brokerages charge a fee for this, called the cost to borrow, or CTB. It's usually expressed as an annualized percentage. This fee matters immensely because it's a constant expense for anyone betting against the company. The higher the CTB, the more expensive it is for short sellers to maintain their positions. Why this stock is hard to borrow right now? Now, let's zero in on INLF. Our hard-to-borrow screener flagged INLF with an astronomical annualized cost to borrow fee of 928.6%. Let me repeat that, 928.6% annualized. This is an extremely high fee, indicating that very few shares of INLF Limited are available to loan out to short sellers, and demand to borrow them is high. With an estimated float of just 1.0 million shares, the supply is already limited, which naturally drives up the borrowing cost when short interest is present. For short sellers currently holding positions in INLF, this nearly 929% annualized fee translates to a substantial daily cost just to stay short. Our internal composite squeeze score for INLF stands at 45.3 out of 100, indicating some interesting dynamics, but it's not in the extreme squeeze potential category right now. Squeeze mechanics explained. How does a short squeeze work in a situation like INLF's? When a stock's price starts to rise, fueled by buying pressure, and the cost to borrow is sky high like it is for INLF, short sellers face a dilemma. They are losing money on their short positions as the price goes up, and they are also incurring massive daily fees just to hold those positions. This dual pressure can force them to cover their shorts, which means buying back the shares they initially borrowed and sold. This buying activity then adds to the existing upward price momentum, creating a feedback loop that can send the stock even higher. That's the essence of a short squeeze. However, it's crucial to understand that a high cost to borrow, even one as high as INLF's, does not guarantee a squeeze. It could also mean that short sellers have very strong conviction that the stock will eventually fall, and they are willing to pay these high fees to stay short. Dilution risk check. When we analyze potential squeeze candidates, one of the first things we check is for dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding and can depress the stock price. This can negate or significantly hinder a short squeeze, even if the cost to borrow is high, because the influx of new shares can easily absorb any short covering activity. For INLF, we found no recent dilutive SEC filings such as -1s, -3s, or 424Bs in the last 90 days, which is a positive sign from a dilution perspective. Recent reverse split watch. Another critical factor for INLF is its recent reverse stock split. INLF executed a 1-for-200 reverse stock split just 24 days ago, on July 6, 2026. A reverse split reduces the total number of outstanding shares, effectively making each remaining share more valuable and resetting the share price higher. In the microcap world, we've historically observed that many stocks tend to see renewed volatility or even a price pop within about a month after a reverse split. While this is a pattern seen in some microcap names, it is by no means a guarantee for INLF. It simply adds another layer of complexity and potential volatility to the current situation. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For INLF Limited, if you're tracking its potential volatility, here are a few things to keep an eye on. First, continue monitoring the extremely high cost of borrow fee. If it stays this high, or even increases, the pressure on short sellers remains. Second, watch for the shares currently available to borrow. If the supply dwindles even further, it adds to the squeeze potential. Third, volume is key. While today's volume is below average at 0.4x relative volume, a significant increase in buying volume on strong price action would be a more compelling indicator. Finally, keep an eye on technical levels and broader market sentiment for microcaps. INLF Limited presents a fascinating case study with its astonishing 928.6% cost to borrow, limited 1.0 million share float, and recent 1/4-200 reverse stock split. This combination creates a highly volatile and interesting dynamic in the market. While the conditions for potential short squeeze are certainly present from a borrowing cost perspective, remember that high CTB alone does not guarantee a squeeze, and short sellers can have strong reasons to remain in their positions. Always approach these situations with caution and a thorough understanding of the risks involved. If you found this breakdown helpful, please hit that like button, subscribe for more in-depth analyses, and let us know in the comments what stocks you'd like us to cover next.